Dividend income is better than interest income. This is because dividend and the capital gains do receive preferential tax treatments relative to the interest income. So building an effectively diversified portfolio with tax efficiency in mind is a key way to building wealth and accelerating growth over time. Today's video, we look at 5 ways that you can use to expand your returns from your investment by taking advantage of tax incentives that are offered by the government. Why so? When we are investing, there are so many middlemen, and the choice on how to expand depends on how much you know and how much you understand the market. Government in its borrowing does competitively offer certain incentives that are within tax avoidance as the legal way that is provided that you can take advantage of loopholes or incentives created by the taxman to maximize or to reduce your tax liability. These are my 5 ways you are going to use to expand or increase, maximize your investment income using tax measures. Number 1, we are looking at the amount you are investing. Majority of us lump up or pack too much money in money market funds and other high yielding accounts, not knowing that by virtue of the amount that you're investing, you can take advantage of an incentive that is offered by the government to increase your return. And that is where competitive bidding comes in. If the amount that you have packed in your money market fund, if the amount that you are keeping in your high yielding account, saving account, hits an amount to a tune of 2 million or more than that, it's advisable you split what relates to your long-term goals and pack it or invest it in directly in the primary market. This is because if you are going to invest more than 2 million shillings, then you get a leeway to bargain your return or your interest rate. That is essentially what we call competitive bidding, in that those who invest less than 2 million, legally you are not allowed to quote your interest, the interest that you expect to be paid. Such small investors or retail investors, to be precise, are paid by the market generated interest rate. Those who are putting in more than 2 million, they are required to quote a rate of return, the interest rate that they want the government or the central bank to pay as a return on that investment. And therefore, if you have built your emergency fund, if you have saved so much that because even in the case of an emergency fund, when we say you require to build a minimum of 3 to 6 months worth of your living expenses, it doesn't mean that all the amount need to be stuck in one account. Again, even if you were to lose your job at that moment, you will not exhaust the entire savings in one day, in 1 month. It's supposed to cover a period of time, usually 6 months at the very minimum. Therefore, you can set aside and invest part of that amount and with a view of expanding the return. That's what we're saying, pull out that 2 million, put it directly, save directly in the primary market, purchase your bond directly from the central bank. That 2 million, you are able to recover or generate interest that is higher than the non-competitive investments. Number 2 is on duration. You have served your money market fund. You have serviced that account for the last 15 years, for the last 10 years. The truth is, when you invest for a duration of more than 10 years, you get a tax concession. You save on tax because the government withholds, or the rate of return, the tax that is charged on an investment that is more than 10 years is less by 5%. Instead of the usual 15% withholding tax that is charged in the money market fund, in this case, where you have invested for more than 10 years, that's a long term. Those are the portion of your savings that you target for long-term goals. That investment shall be taxed at a withholding rate of 10%, meaning that you will have expanded your returns by 5%. That is not main return. That is a huge amount. If you take an example of a person who has invested 100,000, just a mere example, and the horizon is 10 years, meaning that they will be taxed at 10%. If this amount was invested in a money market fund, let's assume at 18%, the total amount will be a return, the interest will be 18,000. If you deduct a 15% withholding tax on that amount, that will be amounting to 2,700. But if this amount was invested directly in the primary market for over 10 years, the 18,000, the withheld amount of tax at 10% will be 1,800. The difference between the 2,700 that was directly at the 15% and the withheld tax of 10% or at 1,800, that means you have expanded or you have saved 900 shillings out of that by taking advantage of that tax incentive. If you look at the 900 that you have saved and the 2,700 that should have been the 15% original tax, then that amounts to about 5%. 1,800, 900 of 1,800, that is 5% saving. That's a good return. The third way, or number 3, is the type of bond. Purchasing directly from the primary market, we have a special bond, that is the infrastructure bond, and these bonds are issued tax-free, meaning that the amount or the interest rate that is paid out on these particular bonds, no tax is charged on them, meaning that you will have saved, unlike putting the money or stacking your money in a money market fund that would charge you the usual 15% withholding tax. If you invest directly with the central bank and purchase an infrastructure bond, the interest that will be generated out of that investment will be tax free. Another way and a good way of expanding your return on that investment. Number 4 is type of return. There are 2 usual types of investments where you are lending out your money, and in that case you get a return in form of interest. And the other form of investment is acquisition of equity or ownership, which we commonly refer to as common stocks. And the type of return that you get out of such investments is dividends. Now, there are 2 types of dividends or interest, where we refer to one as qualifying interest and non-qualifying interest. We have qualifying dividends and non-qualifying dividends. The qualifying returns, whether interest or dividends, those ones are final taxes. What do we mean by a final tax? That means that the amount of tax that has been withheld shall not be, or that income shall not be included in the other incomes when you are computing your taxes, and therefore you will also not be required to account for that particular tax. When you are earning unqualifying return, it means that That income, even if a percentage has been withheld as withholding tax, you are required to include that income with with your other incomes and tax them at the graduated scale rate, meaning that that income will still attract another tax, in which case the amount that was withheld will treat it as a set-off, and after computing your total tax liability, we shall deduct the amount that was withheld, meaning that there is some additional tax that is likely to be charged, or amount of tax that will come out of that amount owing to your other incomes. So investing, acquiring or earning qualifying return of interest or dividends, and that being a final tax, leaves you with an advantage that you will not likely get an additional tax out of that due to the additional incomes to be taxed at graduated scale rate. Again, you will not be required to account for that income or tax because it shall not be included in your final return. Then the fifth way is where you are investing. That is another factor that you look at in expanding your income or taking advantage of tax. Rarely talked about, interest generated or earned through investments or savings in post bank, they are tax exempt. Any savings or investments incomes that you get out of post bank, those incomes are tax exempt. Least said is that the post bank accounts, the savings accounts, are merely bank accounts, and therefore accessibility is faster than compared to a money market fund, because these accounts also do have debit cards. Flexibility is still available. So comparing money market funds and the savings accounts with the post bank would be ranging as an average investment, where one is looking for quick access of money, security, and flexibility. Because currently, lately, when I checked, the interest or the investment returns that you would get from a savings account with the post bank range in the average of what money market funds that are in the category of 12.5% are paying. Therefore, investment in post banks, though may not rank much with the top money market funds, is a good investment and owing to the item of tax incentive. In addition is insurance or life insurance. And life insurance gives you three things: a tax relief of 15% of the premiums that you are paying with a maximum of 60,000 per annum. Another thing that you're going to get with investment in life policies is premium discounts. And the premium discounts begin as low as premiums of 5,000. If you are buying or paying a premiums of more than 5,000, you get premium discounts. The discount increases if you're going to be paying more than or putting in more than 10,000. On top of that, or a third benefit that you will get out of that is frequency discount, where frequency discounts will occur if you are paying in multiple months, if you are paying in quarterly basis, if you are paying in half yearly or annual basis. There are other discounts that you get, and what they translate into the premium discount and the frequency discounts translate into increased benefits and bonuses. The tax relief is claimable at the end of each year by obtaining certificates of contribution from the insurer and submitting them as evidence to the taxman. Those are 5 ways, and a bonus 6th way that you can take advantage of tax laws or tax incentives to expand your returns on investment. We shall meet next when we are looking at the importance of protection while we are saving and investing as we work at this video next. Thank you for watching.